Silicon Valley Bank and what really happened. So Silicon Valley Bank was one of the top 20 commercial banks in the country. Recently, they had a bank failure caused by a bank run, which led to a capital crisis. Bank run is when customers go and rush into the bank and try to withdraw all their cash because they don't feel comfortable with the bank. They lose confidence in the bank. And a capital crisis is when a business loses cash or has minimal cash flows to be able to sustain its operating activities and can lead to a closure. With this capital crisis, it actually led to the FDIC and regulators shutting down the bank and having to insure whatever they can to their customers. This happened because of the investment strategy. Silicon Valley Bank had a bunch of unrealized losses. Unrealized losses, what they are, is investments that you haven't sold but are losing money. Just imagine that they're negative, they're in the red. So they had put in $100, let's say, and you still had the investment in there, but it's worth $50. So if you were to take it out, you would lose $50. And so when they were investing in low yield term bonds, they were investing at about 2% yield rate. And currently now you can actually get 4% about. So these unrealized losses were caused by bonds that they had invested in a little while back. So when they invested in it post-COVID, they were about 2%, a little lower than 2%. And now actually they are at 4%, a little under 4%. I think it was around 1.8 or 1.9, and now it's about 3.9. So the name of the game is to buy low and sell high. You buy the investment at a low price and you sell high. Or you buy high and you sell high. Here what they did is that they bought high and it went down, it went low. Because their investments, when they bought it, it was at 1.8, and then now they're currently at 4, they're at 3.9. That means that they're down 50%. When you're down 50% as a bank on your investments, you are screwed. When this capital crisis and bank run was happening, they actually had to sell their investments at that loss to be able to cover the customers, their clients. So it was just a giant mess. The investment strategy was bad. The risk management was bad. They should have had economists telling them, no, the Fed is going to keep on increasing the rates. This is way too risky. We can't put all this money into these low-term yielding bonds. So because they had all these losses, their cash flows and cash reserves were actually low, which meant their short-term assets couldn't cover their current needs. So when the public started hearing about these losses, these unrealized losses, and having to sell, they panicked. They took out their cash, rightfully so, because this bank doesn't supply the confidence to hold their money. And you can't blame them for taking out their cash, because I wouldn't feel confident in a bank that invests my money and loses half of it. Luckily, we have FDIC insurance. Unfortunately, for a lot of these clients, they were like venture capitalists and tech startups. So the majority of their clientele were very, very affluent companies with big balances, and now they have to go elsewhere. That's Silicon Valley Bank. I hope you enjoyed this video. I hope you learned a little bit. Comment, like, subscribe for more. Just make sure that you feel comfortable on who you're banking with, because anything can happen. Make sure that if you bank with a public company, to look through their financial statements. Make sure that you're paying attention to their public releases, etc., because that stuff is important.